Hello, everybody. This is the first bet, and every successful person gets interviewed about how they won. Very few people drag them back to the moment before they knew it would work, when the information was thin, when the money was real, and they pushed their chips in anyway. That's what we talk about here on the first bet. I'm Martin Tobias, and I've bet three ways as a CEO, as a pre-seed investor, and across the table at playing a lot of poker. My guest today spent years inside the rooms where the AI products are being built, AWS and Microsoft, the actual machine watching real product, seeing what real product market fit looks like before it became a press release. And about 5 or 6 years ago, he walked away from that and started betting his own money in YC companies, before consensus arrived at volume. We actually met each other running syndicates on AngelList, and now Brian runs a couple of funds. Brian Bell, managing partner of Team Ignite Ventures. Welcome to the first bet.
Yeah, Martin, I'm honored that you would invite me to chat with you. And for folks that don't know, Martin was a mentor of mine when I got started, about 6 years ago. I reached out to him, just cold emailed him on AngelList, and I was like, "Hey, I'm new. Let's chat." And he was nice enough to take the call. I distinctly recall I was at a soccer practice, and you're like, "Hey, can you chat now?" I'm like, "Sure." I'm just walking around the field chatting with Martin, and he's just unloading his knowledge about investing. This is back in like probably 2021. Yeah, so thanks for doing that.
It was. Well,
Yeah.
no problem. I think you know that I've been obsessed about how do you make capital allocation decisions in low information environments for a long time, and I'm glad that more people kind of join that thing. So what I wanted to talk about, I mean, you started doing this, but you've since probably evolved and raised some funds and done different funds. And you said to me in the opening, you've done over 400 investments. And what I'm trying to do here is extract, from your process, how you make decisions in low information environments and the frameworks, so that other people can understand, the frameworks that you use. So maybe you could start with that, not a particular investment, but how do you think about, and could you mention, some ways that you think about how to deploy checks in low information environments? What criteria or decision frameworks that you use to decide to write checks in two guys and a dog, and you've written 400 of them.
Yeah, nearly 400 now. And, I got started like a lot of people do, writing angel checks directly into some companies, some checks into funds and sitting on their investment committees. Some of those funds kind of invite some of their LPs to get involved. And then, after a couple of years of doing that, I realized I was having a lot more fun talking to founders and playing Game of Thrones at Microsoft is what I like to say. So I wanted to do more. So I started a syndicate and AngelList, and that's how we got connected. It's a great way to get started, but you don't have deal flow, right? Or it's very minimal. So one of the ways I bootstrapped deal flow at the beginning was to fish from a pool of really good deal flow, which is YC, right? Kind of the preeminent accelerator. They get something like 20,000 applications per batch, and they only let in 150 to 200 of those. And so you've already have this huge filter of very high quality startups to invest in. And now you're trying to make a decision very, very quickly. Talk about low information and high pressure. A lot of these rounds close weeks ahead of demo day, and it's just like a one and done. There's no due diligence you can do, really. I mean, you get a little demo, you meet the founders, you kind of look through stuff, but you basically need to make a decision that week, almost that day, in order to get into the hot rounds. And that was a big reason we even raised a fund in the first place. We were happy to run syndicates. I never thought I'd be a fund manager. I just wanted to keep investing in startups. And three things would happen. One, the rounds would close before demo day, which was painful. Two, the valuations would change. So I'd have a syndicate open. I'd raise 100K, 200K, go to wire the money, and the founder's like, "Sorry, the round's closed," or, "Hey, I know I
It's
told
now
you
a
a $20
higher
million
cap.
I told you a 20 cap, but it's a 30 cap now. Why is it a 30 cap?" Well, we doubled revenue and the round's oversubscribed. Or the worst thing of the three would happen, which is they'd say, "I don't want to syndicate. How many people in your syndicate? I don't want to send it out to like 600 people, let alone, Team Ignite now is 16,000 people, right? I don't want to send it out to that many people." And so we raised a fund on AngelList, a little rolling fund. That was like kind of our fund zero. We call it fund one, a little $1 million fund. So we could move quickly with small checks and get into the hot rounds. And then you talked
Okay.
about kind of how do we underwrite that? When we got started, we kind of looked at around and looked at what other smart people thought. We chatted a lot about how to make decisions back then. I mean, obviously, you're looking for an amazing team, good founder market fit, a good why. I used to really care about their why. Why are they doing this? I don't know if I care about that as much anymore. But you want like I kind of envision this like, do you envision this person being this NASDAQ bell ringer in 10 years? Do you see them being interviewed on CNBC? And if they're not that kind of quality, that star quality kind of person, they're probably not going to be successful because they have to like go sell people on leaving the comfort of their big tech jobs in most cases, because we invest mostly in, technology startups.
Yeah.
And so you got to be able to attract the right talent. And so you got to have that kind of star quality, that recruiting ability,
Mhm.
coachability, velocity of learning, velocity of understanding the market. Obviously, you got to look for a big problem with I learned this from you. Lots of friction. I actually added that from you into my framework,
Thank you.
and I think about that. How like what friction is removed. Timing is a thing. I want to write a whole book on this. Actually, timing is really tough to get right. You can be too early, you can be on time, you can be too late. I think about this a lot. Like Google was the 17th search engine to come
Yeah.
along. And I think about this a lot. Like if I was an angel investor in like 1997 and Larry and Sergey walked through the door, would I invest? I think about that a lot because
Well, I was
yeah,
an LP in Ron Conway's fund, and he did give Larry and Sergey their first $250,000. And thank fucking God, because
right,
as an angel investor, I would have never seen that deal.
right.
And I still own some of those Google shares. My cost basis is 50 cents. And I
Incredible.
haven't actually talked to Ron yet, but I would want to go back to that point where he met them and say, okay, how did you decide? Because there were lots of other competitors. You know, looking back a little bit later, my own personal decision on Google, why I was glad he invested, is that the product actually was an order of magnitude better than the existing things. If you just did one search on Google, one search on Excite, one search on Alta Vista, you got better results immediately from Google. I switched from Alta Vista and Excite in like one search because the product was just that much better. Now, how did they do it and all the technology? I'm sure he did some diligence around that. But in that case, I think the product was demonstrably better than the competitors, despite there being lots of competitors at the time. So let me just summarize what you said. The first way to reduce risk on low information is to try to pick from a better curated pool. And that's why you do a lot of YC things. Then when you get into that, hopefully better curated pool. And I would agree with you on that. Like if there's 150 companies in YC, even if you're throwing darts at 150 companies, if you're going to get a better result from those 150 companies in YC than 150 random companies on Techstars or on PitchBook or something, right? So you've already sort of constrained your thing a little bit. The second thing that you said is that you raised a fund so that you had dedicated capital and the ability to execute quickly in some of these times where you may have to make a quick decision. And that was a response to a prior investment strategy where your capital was sometimes a little bit slow to be able to commit, which caused you to miss opportunities. So
All the
that was a
time.
compensation of deal structure, which allowed you to move quicker. And then you got into of those 150, how do you pick them? Do you have a rubric, like percent of the founder versus the market versus the product versus traction? And could you share that when you're looking at an individual company inside of YC?
You're asking for my proprietary algorithm, Martin. Come on.
Well, we've had other people share them. If you don't want to share it, you
No,
could
I'm just
say,
messing with you. No, I think yeah, and I led AI at Amazon, launched SageMaker Marketplace. I built a lot of AI in my time, know my way around a Jupyter notebook and how to train models and stuff. And so when I started investing, I just started thinking about first principles, right? How would I set up feature extraction? What are the features that matter, and what are their weights and biases in the model that
okay,
would output a score that would predict success, right? And so what you start doing is you start collecting data. Luckily, with YC, you have a lot of past data. They've done 5,000 startups. There's lots of really good data sets out there on which ones have been successful. But there's an art and science to it, right? So we've built up this AI system over the years where we can ingest lots of data about the founders, their resumes, the transcripts I've all the transcripts of the thousands and thousands of calls I've done, all the pitch decks, and we can basically do some feature extraction there with a weighted scorecard. And the AI has actually figured out the weights in that scorecard, and you can do the same thing, right? Like a lot of machine learning is just that. It's feature extraction, weights and biases, and outputting a number between 0 and 1. And in our case, it's 1 to 5 because that's better. Like that's how we think. I don't think of like a zero point 0.9 startup versus a zero point 0.6 startup. It's better to think of
Yeah.
like, oh, the startup's like a 4.5 versus the startup's like a 2.5. And so actually everything that we do when we underwrite is we've done all that feature extraction. I think there's about 20 features in the model, and these features have friction. They have
Yep. Yep.
founders.
Yep.
They have moat, traction, obviously a problem, category defining. There's about 20 of those things that we care about. And so the AI, by the time I even look at a startup, it's already rendered an opinion for me about like
Right.
how good the startup is. And
Right.
then basically I kind of go through the features and sometimes I override it. I'm like, actually, no, I don't think it's a 4 founder. I think it's a 4.5 because of this. You know, you rated the traction of 4. I think it's a 5 because they're doubling every month. And I think that's a 5 out of 5. And so I'll go back and kind of play with the features. The weights are decided by the AI, but I kind of play with the feature ratings a little bit. And then what I do is I ingest the entire 200 company batch for YC 4 times a year. And I basically stack rank it from, hey, this
Mhm.
is the best possible startup, and this is the worst one in the batch. And then that way,
Okay.
I prioritize my time. I do end up manually reviewing everything. And I do this outside of YC too. So half of what we do is YC, half is non YC, I would say, about 50-50. And so by time the batch comes along and I'm just about to head as we record into another batch, because demo day is coming up in about a month, I'm starting to look through that stack rank now.
Okay. So one way which is new maybe in the last year or two, to make a low information decision is to just get more information. And AI is an amazing thing to close that information gap in ways that you couldn't even 5 years ago. 5 years ago, you're doing your own Google searches for competitors and trying to troll their LinkedIn. And now AI can do a lot of information gathering, and you have over the years figured out which of the things about a company or a founder is correlated to returns by back testing it against some other data. So even though people think there's not a lot of information, there's actually more information than you would think in some of these things by looking at past performance of YC companies and being able to extract the data.
And all your
I
past
remember.
performance too. Like the benefit that we have being in the industry, you've been in it a lot longer than I have, is I probably looked at 10,000 companies a year now for 6 years. So I have a data set of probably 40 to 60,000 companies. A lot of things that I invested I shouldn't have. A lot of things I passed on I should have invested. And so I have a lot of these. They call it F1 score in machine learning. True positives, true negatives, false positives, false negatives. And so you can actually calculate your, investor F1 score over time and see how good you personally are and your AI is. And together, I think the future of investing is probably some sort of a hybrid. And there's a lot of research on this that hybrids, human AI hybrids perform better than either alone.
Yeah, I agree. So you collect some data and then you stack rank them, and then you decide out of the 150 companies, I'm going to meet these 20. And then what are the human elements that you apply? Is it a feeling? Is it a trust of the CEO? I mean, what are green flags and what are red flags that you see when you actually meet the CEO?
Yeah, that's a good question. And a lot of it comes down to hunch, right? I think, and pattern recognition. When you've been in the room with Andy Jassy at AWS and he's grilling you on a project, you kind of know what excellence looks like. When you're surrounded by that level of competence, I've been around the A players. I don't even think I'm an A player. I'm probably like a B player. But I'm a B player who can spot A players. And so you're kind of just trying to spot those A players, right? Because A players attract B players and so on, is as how the saying goes. The second question was around red and yellow flags. which our model does pick up on, and we actually have an output for that as well. I'm looking it up right now. I have this long framework in front of me. There's all kinds of rules that we've developed over the years around there. Yeah, there's caps and all kinds of different gates, th- where the AI will trigger and say, "Hey, this is a pattern that we've detected that doesn't work in the past, and this is a pattern that
And
we've
what would be
detected."
some of those that don't work, the cases against or the yellow or red flags?
Yeah, it could be as simple as like a capital inefficient growth. It
Okay.
could be things like retention, like, hey, yeah, they're growing 100% a month, but did you notice that their logo retention is, 67% and their net revenue retention is, 80%? And how does that compare to all the other startups in the data set, right? What does excellence look like? So there's a little bit of like, here's what the positive signals look like, but there's also all these like negative signals as well that can happen. And we could sit here and I could read this model out to you. If I read this whole model to you, it would probably take at least an hour to read verbatim every word in this model, which I won't do. Obviously, it's
No, we we
proprietary,
we
but
we don't wanna do that. But let me ask you another question about YC, and one of the things that they're very good at, so they go in with a particular plan and this and that, and I invested in a company that got into YC, and what they're doing today is completely not what they were funded coming out of YC. The amount of pivots that we see coming out of YC, I don't know what the numbers are. It's probably 50% of the
yeah,
companies
it's
that come
it's
out of
it's it's
YC.
probably not higher than 50, but it's probably not lower than like 15 or 20. Yeah, I don't know exactly the
It
pivot.
it it's a
Yeah,
high percent. So how do you
yeah.
think about pivots in your underwriting framework? Are you okay with them? Is that what you expect? Like the company that I invested in, they were they had a generative AI search product to help brands show up better. They got into YC on the basis of that. They got funded in YC on the basis of that. And then basically about 3 months later, the CEO said, there's too much fucking competition. This product sucks. My churn's too high. I just don't think I can create a defensible business here. So he took his $4 million of YC, pivoted into a completely different business. That business is actually doing better. But, but the fact is that the CEO was smart enough, and if go back to the kind of founders YC wants to back, they should be smart enough to figure out the pivot, right?
And that's why founders is usually the first and last thing. If you
Yes.
ask a lot of VCs out there, they'll say it's founders first, founders second, and founders third. Because especially before you're like 1 or 2 million of ARR, you don't know if you have something, right? And even sometimes when you reach 1 or 2 million of ARR, you still have to pivot, right? That's why I've actually developed this rule. Maybe if you end up interviewing your founders, is I don't invite founders to the podcast anymore until they're at about 1 or 2 million of ARR to the Ignite podcast, because I've had founders come back to me and say, "Hey, can you remove that podcast because it's talking about something that we no longer
That we
do?"
don't do anymore.
Yeah, and I've had to do that a few times now in 300, almost 300 episodes. We're like, you know what? That talks about something we don't do, and we've pivoted away from. And yeah, so that's challenging because these YC companies, they're raising at 30, 40 caps, right? With, I don't know, 500,000 of ARR in most cases at that cap. And so they feel like they have something, but that they may not, right? They may decide that I can't capital efficiently grow in that space as good as I can. And we actually have this 11-point fragility score in our framework. And these are picked up from the data set over time. Founder fragility is one. You can have like a single point of failure. So solo founders kind of are weighted down a little bit in our model. Or if you don't have strong complementary skill sets, right? Like if you don't have like a strong business person, strong technical person. Market fragility. So you're expecting the market to shift. And the thesis is if the market shifts this way, then everything will work out. But if it turns out to not shift, like turn in the way that you thought it was going to turn, if you're betting that this thing becomes a unicorn based on how the market's moving and it doesn't move that way, so we have a market fragility score as well. There's also product and capability fragility. So what does the success depend on unproven research or hard physics, deep tech that you haven't proven out, that you have no IP for? There's GTM fragility, right? So you can have like a good GTM score, which is in our framework, but you can also have the inverse of that, which is GTM fragility, which means you depend on one particular kind of go to market motion or partnership or platform, which creates a lot of risk. And I could go on. There's 11 fragile vectors that you have to analyze too with all these startups.
And what percentage is the fragility score in your overall thing? If the the
Well,
founder
our
is
yeah, it's
50%.
interesting. Our model is actually it has multiple scores. It has a power law score, which is kind of like, hey, if everything works out, is this like a $10 billion company score? Then it has like kind of the weighted scorecard, which are these 20 factors that we care about. Then it has this fragility score, which is like, hey, how fragile is the thesis here for the startup? Yeah, and then it has the kind of the what you were kind of getting at, the red and yellow flag score. Like, are there any is there anything here that doesn't seem right? Right, that comes up in due diligence. Right, if you dump the data room into our AI, it can come up and basically say, hey, they said this in the call, but I checked that and that doesn't match.
Yeah,
And like, not that founders are being they're not lying to us, but sometimes they're kind of stretching the truth a little bit. And sometimes they're out, like every once in a while, like 1% of the time, they're outright lying. Like they said they had this is credential and they do not,
sure. Yeah, yeah. I
and
mean,
that's the power of
I
AI now is like we can dump data rooms in the cloud and ChatGPT and build up a model and see all this stuff at a glance. And man, I can't imagine what it was like for us, 5 years ago, having to do all this stuff manually. It's just
well,
crazy.
so what I think is what I'm hearing you say that's new in the last couple of years that you can improve your information state even in an early thing like this in a way that you couldn't even just 3 to 5 years ago. Because I would think venture decisions, when I started doing syndicates, were much more related to the gut or a very limited amount of reference checks that you might have done or feelings about the market. But now you can increase your information state quite a bit with AI, and hopefully that's going to improve returns. I certainly think it will. But the funny thing about venture is that your initial decisions, you probably have an idea of if your decisions 6 years ago were any good, but your decisions in the last 12 months, you have no idea yet whether they're
Right.
any good. There's
Yeah.
a
It's like you're
time
playing poker, but you don't
delay.
find out if you win the hand for 5 years.
Yeah. I was just talking to another poker player. Poker players have low information too. They have two cards. You have to decide if you're putting money in the pot, but you get an immediate feedback on your decision. In venture, you might not have a feedback for 10 years. You might have within 18 months a feedback of would the next investor mark this up? Have they gotten enough traction? But that's not sort of the final this decision at all. So having done this strategy of writing, smaller checks into a bigger pool of YC things, do you have written non-YC checks too? Do you think differently about
Yeah.
non-YC? Or
Yeah, that's a benefit of starting from a pool like YC because it's such high quality that when you see non YC companies, you're kind of like your brain is primed for YC level quality, and so now you meet companies outside and you're like, gosh, you don't even know how bad you are.
yeah,
Like some decks I'll see, my AI will score it like a 2.2, which is like an automatic pass, right? And there's a lot of I'd say the range of AI scores for YC at the top end is like a 4.2. A 4.2 or 4.3 is a very, very high, almost automatic yes, down to maybe a 2. That's kind of the range of scores I get out of Y. And that's just YC. So you can imagine non YC, the range of scores I get 1.5s and
yeah, yeah.
1.6s. And then if it's above like a 3.5, I'll tend to kind of take a closer look at it and meet. But usually the AI has gotten so good and I've trained it now over years and years and years that I very, very infrequently disagree with it. Right.
Mhm. Yeah.
You know,
But it's because you've been iteratively,
yeah,
redesigning it and adding new things to it over time. So would you say if there were somebody else just getting started and trying to make investment decisions in startup companies or other capital allocation decisions, would you say that's a framework that has worked for you is paying attention to your algorithm and refining it with data, over time so that
I think
over time
so.
the decision gets compoundingly better, hopefully?
I think, yeah. And it goes back to this like old phrase that's floating around is, AI is not going to beat you. It's a person using AI that's going to beat you, right? Or take your job. And I think the same thing goes for venture, right? I think AI is not going to replace venture capitalists. Like there's still just so much human intuition and human relationships in this business. But a VC powered by AI is a very powerful thing. And so if you're getting started and you're thinking about allocating capital and doing syndicates or making angel investments, you absolutely should be using AI and you should be trying to work with it on every decision because it's going to teach you, right? It has 150, 160 IQ, right? It's probably smarter
It
than you.
does.
And so you can plug stuff into it and say, what do you think about this investment? Right. And then start developing your own framework for things that you like and don't like, and things that have been successful and unsuccessful. And you can build up your own algorithm over time.
I think that is good advice, and I haven't heard that from other investors yet. Is that you need to build up your own algorithm, adding your own takes against the AI and the data that you're doing to align with what you think is related to returns, and you will be judged by those returns by your LPs in the future. But when I started using AI, about 3 years ago for investment analysis, one of the things that frustrated me is that it told me to invest in fucking everything. It was terrible about it.
Yeah.
And
Yeah.
and
Totally.
and it
I remember
wants to
that.
tell you
Yeah.
what it thinks that you want to hear. So I had to actually put in a bunch of adversarial stuff there. And maybe you could share a little bit with some of the gremlins or some of the problems, because of or
Absolutely.
challenges that you've had with getting AI to, conform with the way you want to do investments versus the way it might want to do investments. I actually found in the beginning it to be hard to have it understand my thought process because it was very sycophantic even in
Yeah.
wanting to do every deal.
Yeah. And especially this was a problem with earlier versions of ChatGPT, definitely 4.0 was a sycophantic. You remember when they, sunsetted that model, people were just all up in arms because they missed their sycophantic friend, right?
Yeah, yeah, it was just patting them on the back and positive reinforcing of the,
Yeah, you're
loop
so
on
smart,
whatever the fuck
like,
they
oh
said.
gosh, that's a good idea. Yeah, you should
That's a great
go.
idea, Martin.
Yeah, you should have
You're
a
so
snow
smart.
shoveling business in LA.
So how
Yeah,
did
and
you
so we've
design
actually developed.
adversarial things in your process? Yeah.
Yeah, Mark Andreessen actually has a really awesome prompt. I don't know if you've seen it that I kind of copied and paraphrased, but it's something around truth and accuracy and don't tell me what you think I want to hear. Truth above all else. So I kind of copy that as a custom instruction into my AI, and that helps a lot because now it almost painfully tells me what I don't want to hear in a way that I'm like, you're right. Like, oof, I really wanted to make this investment, but yeah, these three or four things are missing. And so it can be really painful as an investor because sometimes you want to be validated because you've already made the decision and the AI is telling you no, or vice versa. You're like, I don't think this is a good company. And the AI is like,
Mhm.
no, like look at these like five things that you're missing. And so a lot of that is it's almost like a thought partner. Our friend Genevieve
Yeah.
thinks of it that way. It's a thought partner, and it really is. It's this it's almost like it's the Team Ignite investment committee, right? I, plug everything into the AI that's been trained on, tens of thousands of deals, and we have a conversation and try to come up with a consensus on what we both believe. And sometimes I override the AI and sometimes it overrides me, and it's it's a partnership in a way.
So talk to me a little bit as we get to the end here about some of the decisions that you've made, the checks that you've written. You use a combination of AI and your own pattern matching to write the checks. But not all the checks work out. So if you look at the bottom 20%, the ones that didn't work out, do you have a process of going through those as to why they didn't work out and changing your decision process? Or is that just expected? I mean, would you still write the check again to the bottom 20% that failed, given the information that you knew at the time? Or, how do you think about the ones that didn't work out despite you having the high conviction at the beginning?
Yeah, this is what's fun about being an investor because we were talking before we started recording is it's fun to think about how you make decisions, right? And there's this really good book, The Heath Brothers.
I haven't seen that one.
Yeah, it's called Decisive. I read it like 10 years ago. Really great book on making decisions. And you want to widen your options and prepare to be wrong. And there's just like this framework of how you make decisions. And I love actually going back through the decision making process on successes and failures. So when I get a big, hey, we just raised this massive, 650 million Series B. I'm like, oh wow, this is. I mean, I got in at a 5 cap, right? So I'm sitting on 100x. Let's go back and like think about what we saw, what the AI thought back then, and how much better it's gotten. And I'll run through the algorithm and say, hey, imagine it's 2023 or 2022, and here's all the information you have. Run it through the AI again, score this whole thing, and we'll kind of refine it. I'm like, okay, well, you actually scored this a 3.8, but this turned out to be really successful. This went 100x for us, at least on a gross basis. So let's think about how we can improve and invest in more companies like this. And the inverse of that is what you just said, like the shutdowns. And I've developed 8 gates in the model. There's 8 gates that we've developed over the years from failures where, like, if this is not in there, if all these gates aren't at least like complete passes or partial passes, we won't invest. And these gates are kind of there to sort of protect the downside a bit. But there's always like this like push and pull between. It's hard because even though I do 100 investments a year, I'm only investing in about 1% of what I see. About 50 I'm only investing in 50 YC companies a year out of 800 that go through YC. But it's still a really hard decision. There's
Mhm.
800 really amazing companies there that all think they're going to be, the next Stripe or whatever. And our job as capital allocators is to try to really tease out what is that 1 or 2% that you're seeing that are really, really promising.
Okay.
Yeah, and it's fun. It's fun to kind of go back and take your lumps. And what I've realized as an investor, allocating other people's capital now for 5 or 6 years is, man, I really didn't know what I was doing back when I started. I looked at some of the
In the
investments I
beginning.
was making back then. I had no clue. Pre AI, pre all the lumps. There's this phrase in real estate that it takes 100 investments, to make a real estate investor. In VC, they say it takes 10 million to make a VC. I think that's really true. I think you got to go deploy into like 100 startups before you really know what you're doing.
I would agree with that. So to wrap up here, like what is the 2 or 3 decision frameworks that you would give listeners to be better at low information decisions that you've found worked for you and you've learned over the last couple of years?
I think is, use AI, start training your
Using AI.
own model and algorithm and weighted scorecard. Try to go learn from history and try to tease out, because it's not just, if you just do consensus investing, everything's going to get bid up. I mean, you probably see this, right? When there's a super hot round and everybody wants in, you're going to be investing at 100, 200x forward revenue, right?
Yeah.
Maybe like infinite forward revenue. Some companies now are getting huge rounds with no revenue. And so a lot of what we do as early stage investors is try to find that sweet spot of kind of this sure bet that nobody knows about.
So the counter and be counterintuitive and be right. So what is the one counter rate? What is the one mistake that you might have made in the past or that you see people making capital allocation decisions or early stage things still making today that you would tell people to avoid?
Yeah, I mean that's probably gate 5 in our model, and there's lots of different ways to tackle that question. But is there something really differentiated? Is there a differentiated wedge, a path to control, like a control point, a path to a system of action, a system of record? Is it? Have we actually identified the kind of business that it actually is and how it grows and what the particulars of that business? Is it which trajectory is this company on? Is it distribution first or research first or something else? And so really trying to understand like how that business is going to compound, because really we're not in the business of investing in single million digit companies. We want hundreds of millions of revenue companies in the future.
So the mistake that people make is investing in features instead of platforms, or what is the mistake that investors can get sucked in to?
That is something to really look at twice when you're making an investment. Is this a feature in somebody else's platform? Right. That's another feature in our model is what's the bundling risk of the incumbents, right? Because
Handling
sometimes
risk.
you have a really nice feature, but it's not a platform. And I'm sure that's why some people probably passed on Google. It's like, oh, a nice demo, kids. And I think about that a lot,
Well,
but
I think about
Yahoo
that.
has, is a $1 billion company and they're just going to build it. They'll just kind of integrate that feature into their catalog of the internet.
I think about that a lot, and sometimes even something that looks like a feature, if I believe I could, there is a path to make it a platform, I would still invest. That's exactly what I did in DocuSign. DocuSign was actually very hard to raise money for in the beginning because people are like, that looks like a feature, signing a contract on your phone. Adobe could copy that in 5 seconds. Why is this a company? And what ended up happening is they turned it into a platform with signing, ordering emails, and they integrated to things. But it took a lot of work to turn it from a feature into a platform, and they got rewarded richly for turning it into a platform. So some things that might look like features can turn into platforms. And the mistake I see a lot of people making is things that look like features and then they stay features.
Yeah, and that gets into the founder quality vision question. One of my favorite questions, like, what's your vision for the future? 5 or 10 years out, you've built this thing and it's really successful. What does the future look like? And you kind of want to listen for that sort of language. The vision's way beyond the feature. The vision's way beyond this like initial wedge. They have this aspiration to build this massive company that makes a huge dent in the universe, right? To use a cliche.
Absolutely. All right, Brian, this has been very good for me. I learned
Oh, and
a
one thing
few
I wanted to
things.
mention, because it's so hard to make decisions in startups, it's also really hard to invest in GPs like us. And so
Yep.
I have a book coming out in September
Oh, great.
called, yeah, it's called LP, The Insider's Guide to Investing in Venture Capital Funds. And I wrote it because I was an LP once, and I didn't know how to evaluate venture funds. I actually invested in a couple of really bad funds. I've interviewed a lot of LPs, really great GPs like yourself. And so I literally wrote a book that comes out September 15th at wherever you can buy books, Amazon, and just wanted to mention that here.
Absolutely. I would love to read that. I had on earlier, you can listen to the episode with Aram Attar. Well, actually, it's coming out next week. He's an LP and he has this whole framework on how you pick GPs, and he can explain that. I'd be interested how it compares to your thought. I'm an LP in a bunch of funds too, and I love being both a GP and LP. So you've got a book coming out. Where else can people find you if they're interested to learn more about Team Ignite? Twitter, LinkedIn, website.
But yeah, and you can find our on episode 252 of my podcast as well.
Okay.
And then, so yeah, we're the Ignite podcast, Team Ignite Ventures. So you can find us at teamignite.vc. We just rebuilt our website with AI. So go take a look at it. It has lots of information there.
Okay. Well, thank you for your time, Brian. Let's do more deals this year.
Yeah, likewise. Thanks, Martin.